Hello, everyone. My name is David Scherer. I'm co-CEO of Origin Investments, a real estate investment firm that creates both private and public real estate portfolios for our clients, all through our app, Path by Origin. To date, we've invested over $1 billion into private real estate alone, with a focus on multifamily. We currently have 3,500 multifamily units across our 11 target cities in the US, and we have another 1,000 multifamily units that are currently in development and should be delivered within the next 1 to 2 years. Today, we plan to focus and discuss specifically on the economic impact of the pandemic and how it relates to the last downturn, 2008 to 2010. Origin was founded in 2007, so this isn't the first downturn we've seen, and we're going to draw some of those parallels. We're also going to cover fiscal and monetary policy over the last 6 to 8 weeks and how it relates to the 2008 to 2010 downturn as well, both in the scope and the speed of what the federal government and the Federal Reserve have done. And specifically, how does that impact real estate and private real estate valuations? From there, we're going to focus on opportunities in the marketplace today. We added a new section today called the Deal of the Month, and both myself and my colleague Dave Welk are going to cover an active deal that Origin is pursuing in the current market environment and why. Thank you so much for the 1,000 participants who joined us last month. We had a lot of great feedback, including a lot of positive reviews of Origin Take 5, which was our rapid fire Q&A section. Just a quick reminder for people who are new today. You can access the Q&A function by just hitting the screen, and if you go down to the bottom of the screen, you'll see a Q&A. If you click that, you can type in your question in real time, and we're going to actually try to answer it. So roughly 30 minutes of presentation and discussion between myself and Dave Welk, and then we're going to hit the Q&A section pretty hard at the end. I would like to introduce my colleague and friend, Dave Welk. He's been at Origin for 10 years. He's prolific in acquisitions. He runs all of our Southeastern acquisitions himself with the support of our analysis teams in Chicago. He lives in Charlotte. He's also managing director of acquisitions nationally. So he oversees, trains our teams that are also in Dallas and the Texas markets, as well as Nashville, Florida, and the Western markets, which is spearheaded by our Denver office, led by Tom Briney. Cool story about Dave. Dave's very competitive. Many of us are at Origin. I think it was either 2 or 3 years ago at our basketball game that we had before our company retreat in the fall. Dave forgot his basketball shoes, so he played what he thought would be a game or two in his dress shoes, which became quite a few games, and I'm pretty sure he needed a wheelchair to get back to the airport. Dave, it's great to have you back today.
Thanks, Dave. And yes, for those of you who don't know, Cole Haans are built for versatility. They're great in the boardroom and then also on the hardwood as well. So great to be with you, Dave.
Yeah, I think you actually were the one who got me interested in Cole Haans. So thanks for that. Dave, let's jump right in. The first section is really going to be about fiscal and monetary policy over the last 6 to 8 weeks. We're not going to be super technical because this is more about what that sets up for real estate. But we do want to give you a backdrop because it's quite extraordinary. So Dave, why don't you start with that?
Yeah, sure, Dave. I mean, I think, as you mentioned, I think it's a good place to start to discuss the speed and the magnitude of the Fed policy responses today in this COVID environment versus 2008, 2009. And that's going to really provide a lot of good context. And so just to take us back to the beginning here, in mid-March, when we were only a few weeks into this domestic COVID fight, the Fed intervened with an unprecedented pledge of its balance sheet. They authorized about $4.5 trillion for asset purchases and lending programs, which, again, to put it in context, that's about 22% of our $21.4 trillion annual GDP. And to date, and the pace of that utilization of those tools, we're about halfway deployed at the moment. And I'm going to throw up a chart here, actually a couple charts, so bear with me as I try and get a little bit tech savvy and share my screen. Let's see here. All right. Assuming you can see that, Dave?
Yeah. Mm-hmm.
Okay. So the first chart does a really great job of telling the story of just the overall pace of the Fed intervention. So as you can see on the left in the gray column, you can see some of the QE measures that were deployed in 08 to really to 2010. But really, as you can see from the chart there, the expansion of the balance sheet didn't really happen until the QE programs that took place in 2010, 2011. But to put into perspective, at the height of the QE in 2010 and 11, the Fed was purchasing about $3 to $4 billion of treasuries per day, or I think as the chart says here, about 120 billion of treasuries per month. Over the past several weeks, the Fed has been buying 70 billion per day. So 3 to 4 before, 70 billion per day currently. Now that's tapered closer to 35 billion a day as the credit markets have somewhat stabilized since then, but it's just the sheer magnitude and the pace at which they were buying treasuries, the Fed was over the last several weeks is impressive. To put in context of the size of the Fed balance sheet, it's roughly 6.6 trillion today, which is about, again, 31% of GDP. And with the remaining policy tools that they've enacted, that's likely to hit 9 trillion over the coming months, which is, again, 42% of overall GDP. So let's put that in context on comparison of the GFC in 2008, 2009. Total policy responses there, 831 billion. So not even $1 trillion of stimulus was enacted initially, which was about 6% of GDP. And then in 2009, the Fed balance sheet peaked at about 2.5 trillion. So we're heading for nearly 4 times the prior peak in terms of the size of the Fed balance sheet, and we'll get there in about 1/3 of the time. So one of the other things I wanted to point out too that's maybe most interesting / alarming is that the Fed this go around is considering direct equity purchases, which in the public companies, and is also backstopping municipal debt, which that was never contemplated in the prior GFC. So the next slide I'm going to show here does a pretty good job of putting into context some of the global responses, really from a central bank liquidity and government stimulus perspective as it relates to a percentage of GDP. So as you can see, Japan and the Eurozone are the next highest in terms of their stimulus at 23% and 22% respectively of their GDP. But notably, we are 2.5 to 3 times the amount of other countries in terms of our central bank liquidity that we're injecting. But we're less than Japan and the Eurozone for government stimulus. So what does this all mean? What are we taking away from this? There's a huge amount of capital that's been injected into the global economy here to backfill what is a large void in economic activity. Not sure entirely what this means for long-term consequences. I know there's been some questions that have been asked of us for that, but we can try and take a stab at that later in the presentation.
Yeah, thanks, Dave. It's staggering if you think about, there was so much pushback in 08 to 10 about government intervention. And we're literally talking about right now, let's think about what you said. It was 70 billion a day, and it's gone all the way down to 35 billion a day. But at the height of the great financial recession of 08 to 10, it was 4 billion a day. So we're all the way down to 9x of that. We were at 18x of that. So the big point here is we're completely off the rails. I'm not making a political statement here. I actually think it's probably correct in what the government is doing, the Federal Reserve is doing in response. I'm just saying that the financial markets and the real estate market, there is no precedent. And we can look to the last one, but we're 10x of the last one. So no one really knows what the short term and the longer term effects will be of this.
Just to verify, my screen is no longer being shared, correct?
Correct. Yeah, exactly.
Okay.
So
okay,
great.
Just quick question for you, Dave. Is what were you seeing? Maybe it'd be helpful to talk about what we saw as a firm, and I was not quite there yet in 2008, 2009. I joined the firm in 2011. But what were we seeing back then in private real estate leverage strategies then versus now?
Yeah. So the thing, the quick answer is, I think of the expression, the more things change, the more they just actually stay the same. And I don't, what I mean by that is everything that you saw happen in March and early April this time was the same thing we saw in '08 to 10, which is essentially all of the business plans that relied on a lot of leverage, even if their collateral or what they invested in was relatively what they deemed low risk, was completely flushed in both cases, right? So in the event of '08 to 10, you saw, for example, hedge funds who'd invested in RMBS and CMBS, but then levered those positions highly. Um, they were forced to sell, had margin calls, had to sell, um, pushing, and that force was pushing the CMBS and RMBS, their collateral even lower. And so they were getting more margin calls and they were having to sell. And, and so this time it just sort of shifted. Maybe it wasn't that, although it was in some part the same, but there were new entrants to the market, like the mortgage REITs, for example. Um, their collateral are residential mortgages across the country. And that should sound kind of familiar to those who are investing in '08 to 10. Um, it resurfaced this time because they then take those mortgages, they levered them, 8 to 1, 9 to 1, and they were flushed. And you saw, if you haven't been following this, just pull up any mortgage REIT stock you want or the index, and you'll see that it's down 50% still, but on the bottom it was down 70%. And there's actually still a lot of people that are questioning whether those highly leveraged strategies, they're going to make it out. One thing that did change, Dave, is coming out of '08 to 10, some of us will remember that there was legislation called Dodd-Frank. Dodd-Frank imposed new standards on banks. And so those standards included the Basel rules, which essentially made a bank only able to lend as much as their capital base. And that was always true, but it imposed stricter standards on that ratio. And so banks in the last 10 years have really been lending less into less risk assets, but they were replaced, and they were replaced by debt funds. They were replaced by other entrants into this debt space. And ironically, the banks, they weren't making the first level of loan risk, but they were making the next level. So they would then lend or provide repo lines to those initial lenders. So they were still in the game, but maybe not the original origination point. My point is, there was still plenty of leverage in the system. Dodd-Frank didn't change it; it just moved it. And so, again, we're talking about real estate here. So let's bring it back to real estate. Why don't you share with the viewers a couple examples of what we really viewed as a very aggressive lending period, which was 2016, 2017, all the way to February of this year. And candidly, that makes it hard for us, Origin, to compete in the market because we don't use a lot of leverage. But some of our competitors who do, they're able to pay more for assets because they have access to so much leverage. So why don't you give us a couple examples of that, Dave?
Sure. I mean, as you mentioned, it was really the debt funds and the amount of capital that flowed in this space that was creating compression of spreads and increase in leverage levels. But a couple of tangible examples that we don't really compete. We don't compete in the hotel space, but just as an example of a asset class that bears significant asset level risk, we were seeing that some debt fund providers out there were financing hotel development projects at upwards of 85% leverage. So I mean, your equity, and we all know where hotel operations have been performing as of late, your equity is likely to be impaired. Now, some of those development projects are early in the process, and we hope that there'll be a rebound in the economy. But that was an example of a risky asset getting a high level of leveraged financing put on it. Maybe more notably to our specific area where we invest and some of the challenges that we were competing against. But some value-add multi-projects were getting levered, pre-COVID at around 90% leverage with some of these debt funds and rates that were in the upper 200s over LIBOR. So call it, maybe mid to upper 3% range. And that's a super tight, low coupon for going up to 90% of the risk. Those are just two, tangible examples to provide.
Yeah, and it's changed a lot, and that's been one change we've seen in the private sector. Again, we focus on multifamily, but within multifamily, you saw a complete dislocation for about 3 weeks of lending. No one really knew where to lend, and that was kind of the March 20 to early April period. It's normalized now, and you can get debt again, initially through the agencies, but now the other lenders are following, and the rates are very reasonable. Actually, they're sub 4% for quality assets, and you can even go down to maybe 3.25, 3.5 on high quality assets with high quality owners who are trying to purchase these assets. But one thing that has changed is standards have become stricter. And so everyone is underwriting in a much, I would say, tighter fashion. And so they're raising reserves for future expenses, taxes, insurance, et cetera. And all of these things, what they really do is they lower your total loan to cost ratios. So whereas before you could reasonably get to 70% with an agency debt on a deal, now it feels more like low 60s. Would you agree, Dave?
Yeah, that's spot on.
Well, we're going to move on. I'm going to talk very briefly about collections. That's been something that has come up quite a bit. And then Dave is going to talk a little bit about what we're seeing in the private market in terms of valuations. We have the benefit of, living in 4 different distinct areas of the country outside of Chicago, which is the 5th, and having people on the ground, but also owning and following the markets and having those networks. So he'll cover the roughly 200 deals we've been tracking, mainly because we were either pursuing them or are pursuing them. But before we get there, I want to talk a little about collections. So nationally in multifamily collections was plus or minus 90% in apartments, right? Our portfolio of 3,500 units that we own and operate was just over 92% collections. Obviously, the national and our number is down from roughly 99.5 to even 100% a year ago this time. You used to collect all of your rent at high quality assets. In fact, when we underwrite, there's called a loss ratio that you underwrite. It goes top line and then loss ratio and then collections. And ours is so low that, we talk about what to use. Do you use 0.3? Do you use 0.2? Do you use 0.4? So obviously to move from 0.3 to 8% is pretty big. That said, I would say as a whole, collections have been higher than people anticipated. And I'll also say that I just got off our investment management. We have a daily call with that team at Origin this morning. And we've gotten about 50% of the data in because you get the data all week. And collections don't come in April 1st. They come in, April 1st, May 1st, but then also the week that follows. So we'll have final data on May next week, but it already appears that it's going to come in above 90%. And a lot of the assets were already above 90%, which is actually quicker than it was in April. So I'll update this on the next call, but it does appear that May is going to be quite strong as well. And David, could be that, some of the programs that they put in place around, extending and increasing unemployment, as well as the direct checks, they're helping these first few months because the data is quite good, and at least in terms of multi. I will say that for those that are, on the call that have retail investments or hotel investments, those collections are very, very low. I think the retail is somewhere between 15 and maybe 35, 40%, meaning best case, 60% of your renters aren't paying. So those are extraordinarily dislocated asset classes, but multifamily is not. So let's move on into the valuation component. Dave, can you handle that, please?
Sure. I mean, and for those of you who jumped on our call about a month ago, I'll talk through a little bit what we've seen that has changed in the marketplace. But overall, pricing really hasn't moved materially in the last 30 days from what we've witnessed in terms of transactions that are still getting closed. And if I were to just kind of bracket where multi is transacting at right now, I mean, the trades that we've seen, they're down 0 to 10%. And by saying down 0, I mean, we've been tracking a number of deals in our markets that have effectively traded unchanged from pre-COVID levels. And there's a myriad of factors as to why, but generally those are high quality assets. They're unlevered or low levered buyers of those assets. So some assets have traded down 0. We've seen upwards to 3, 5 to 10%. I'd say the bracketed range is probably somewhere between 3 and 10%. And the public markets remain a proxy for that, as well as if you look at where multifamily REITs have repriced to, and then you use their debt to equity ratio and compare it to our market, it's a pretty good proxy of kind of plus or minus down 10%. As it relates to office, we've seen a little bit more of a spread there, maybe down 5 to 15%. We haven't really witnessed anything that's selling down 20% yet. And as Dave mentioned, I don't think you covered our office collections, but I think our office collections, based on the last number that I saw, we were roughly 92% collected. So pretty strong there as well. Don't know how much of that is also some of the PPP loans and other federal stimulus that's in play there, but office rent collection has been strong. And we've seen some of the REITs, the public REITs, echoing that as well. The debt markets that you mentioned, Dave, which are a factor of valuations before, they're largely functioning again. And the rates that you mentioned before, they're pretty similar to pre-COVID levels. I mean, within 20, maybe 10 to 40 basis points, depending on the borrower. But where are we getting all this data? It's the 178 deals that we were tracking, before the COVID, and economic collapse, which was about $9 billion of transaction volume that we're actually seeing in our 11 markets. And we're also still in very active discussions with market participants, as deals are getting restructured. And then lastly, we're getting additional information because we are and have been an active seller in our markets. So we're getting real insight from transactions that we are on the other side of as a seller and getting indications of where other buyers are looking at value today. Anything else to add to that, Dave?
No, I think that covers it completely. I mean, just anecdotally, 2 weeks ago, we saw in Orlando, $200 million deals close, multifamily deals unchanged, so January, February pricing. These aren't small transactions, and there's not unsophisticated buyers or sellers involved. And so that's significant. It says a lot. We've also seen deals where buyers have walked away from a 5% deposit. So clearly they think the market's down more than 5%. But generally, most of the activity is clustering around down 2, down 3, down 4, down 5, down 6. I mean, that's where things are happening, with a few outliers. I would say the outliers are generally on the unchanged, meaning they don't retrade. There's very few outliers that we see that are trading down 10. That said, we have deal flow in our pipeline that are high quality multifamily assets where we can take a run at them down 10. So I'm not saying that also doesn't exist. It does. But that's sort of the market, if you will, right now. You can choose to participate in it. A good sell looks like a sell unchanged, a down 1 or 2. A good buy looks like a buy down 10. And anytime I'm talking about this, I mean at the asset level. That's debt and equity, right? Because Dave touched on this with the REITs when he mentioned the proxy REITs. REITs use 50% debt, right? So if their value is down, you have to keep that in consideration. Okay, so I'm going to move on. I want to talk briefly, and Dave, I'm going to speed us up because we want to have plenty of time for Q&A. But we're going to briefly go over 2 deals that we did in the last downturn, and then we're going to do 2 deals that we're doing currently, and then we'll move to Q&A. So an example of a deal in a disrupted market. Remember, if you're in a disrupted market and outcomes are unclear, right? No one on this call, myself included, knows what the growth rate of the US or the global economy is in the next year, or even what the health situation is in the next 6 months. We don't know these things. And so with less certainty, you demand, and should, in private investments, you should demand more edges, like a bigger discount. And that's what Origin was sort of born out of, and we're very good in these markets. So I'll give you an example of the last time this happened. So we were approached, I believe it was in mid 2009. No, I believe it was actually mid 2010, by a relationship that was in charge of the bankruptcy sale for Giordano's, which is a large pizza chain based in Chicago. And this is an instance where the owner-operator had a corporate run and franchise business that was very well run and profitable here. But he actually tried to become involved in real estate, and he bought a large piece of land in Florida and was going to develop it, I believe in 07 or 06. And the lender to him on the business side said, yeah, we'll finance that, but you have to put up your business as collateral. And so when the downturn hit, they seized his business because that was the collateral that he used to guarantee the loan. And they went into liquidation of a business that actually was still profitable, had EBITDA, had a good brand, had sales. And so we weren't buying, because we're not a private equity firm, we weren't buying the business, we were buying all of the corporate owned real estate in the Chicagoland area. And so this is an example of, do we know anything about the pizza business? No, but I know that its cash flows were very steady for the 10 years prior. And even in a distressed economy, they still had sales that were barely trending lower. This is in 09. Their 09 numbers look pretty good. And so we took a run at this, and we bought all the real estate out of that bankruptcy at just north of a 10 cap. Remember, our collateral isn't the business. Our cash flows to pay the rent are from the business, but our collateral is the real estate. And that was the other consideration. They had done a really good job of buying real estate that was incredibly well located throughout the Chicagoland area. And so worst case, if they go under, we own these buildings that are actually at an extraordinarily low basis that we can own and repurpose for other reasons. That's not what wound up happening. Giordano's, the business was bought by a private equity firm that did a very good job increasing their EBITDA. And as we moved out of the downturn, we were winning both because of the basis that we had, but also because the private equity firm was making the credit better and better of the leases that we had. And so that wound up being, through cash flow and appreciation, I believe almost a 4x multiple on equity just over 3 years. So that was a great win for us in a distressed economy. We had to move quickly, though. We literally had 10 days to underwrite a portfolio of real estate and feel confident enough to make a significant investment. And so we executed, quickly in that instance. Dave, do you want to talk a little bit about the Houston medical office building as well?
Sure. Yeah, and just to follow up on that great story on Giordano's, I mean, we're seeing what's happening in real time to restaurants right now. So we may see some of those types of opportunities exist. Again, whether we pursue that as Origin or not, I just think that born out of this location, you're going to see a lot of restaurant retail tenancy, single tenant product that will see some disruption. So interesting to follow, and we'll be monitoring those markets again this time around. But as it relates to our 2012 purchase of an MOB in Houston, a medical office building there, not too dissimilar in that we also participated in another bankruptcy sale, but I'll give you a little bit of why there was some dislocation, particularly in that deal. But there was a medical tenant, a user in the building that occupied about 20%, and they were also an investor in the real estate. And the user partner got into a disagreement with the owner of the real estate, and they vacated as a result. And their vacation from the building then created a stress operationally and the ability for that property to service its debt. So then we partnered with a potential competitor. We surveyed the market and found out who else was maybe circling to buy this note. And we teamed up with them in a joint venture, and we acquired the note at a discount from the then lender. 9 months later, we prevailed in the bankruptcy auction, and in a bankruptcy trustee sale, and acquired the asset. And there was, as I mentioned before, 20% vacancy from that 110 loan, but there was also, during that time frame, there was not a lot of operational focus on the asset. So occupancy was at 52% when we took over the asset. We increased it to 90% during our ownership, which included a large lease. A lease with a large hospital system in the area that had some really strong credit. So when we eventually sold the asset 4 years later, between the increase in and also market rates were continuing to rise over that time frame, about the average of 3 to 5%. But the NOI that we created or generated over that time frame was about a 64% increase in NOI. So we sold the asset 4 years later for about 25% annualized return, which was about a 2.5 times equity multiple. So the point in that deal really is that could have been in distress in any environment. That was a partnership issue between two investors. One just happened to be a tenant in the building, but it's exacerbated, distress is exacerbated in times like this. So you can see partnership level distress in really in any market environment.
Yeah, that's a good point. People are people and partnerships are difficult, but you're right. These times create the friction that leads to more of it. So let's move on to deal of the month. I'll start. So before I start, I just back to wanting a higher discount rate, or another way of saying more edge on a deal, bigger discounts, et cetera. Because it's uncertain, there are two things that we're looking for. Either we want a deeper discount if it's common equity, or we want to move up the capital structure into a more protected position. And that's, in our world, investing as preferred equity, not common equity. And the thing I'm going to discuss is something that we're excited about. This is a program that actually starts with Fannie and Freddie, who, they're issuing a huge amount of loans on multifamily acquisitions every year. Roughly 78 billion annually are done over the last few years. And so what the agencies then do is they tranche out these loans. And the bottom tranche is also the tranche that's tasked with management, especially if it hits a distressed situation. So these bonds have roughly 30 to 50 loans in them, all multifamily assets. And so what we're interested about this is, number one, there's a huge barrier to entry to get into this market. You don't show up with money and say, I'm ready to buy this tranche, because the bondholders themselves want to make sure that the people buying this tranche, because they're tasked with, if any of these loans become problematic, they have to actually manage that process and potentially manage the assets through foreclosure and hold the value. So that you have to have multifamily expertise as a seasoned operator. We have that. You have to be a borrower from the agencies and have an established knowledge of being on the borrower side. We obviously have that. You have to have an understanding of bond auctions, and we obviously have that. And then you need available capital. And so there's real barriers to enter this market. We are in the process of trying to get into this mix. There's not many participants on the buy side. And so, number one, we're interested in the protected position, because when the agencies are underwriting, they're underwriting, like we said before, to a stricter standard, number one. And that standard would start with, they're saying, okay, we think vacancy will be higher, growth rates will be lower. We're going to set up larger reserves for future expenses. And so you're starting with a more conservative underwriting anyway than you would have had in January 2020. Secondly, most of these loans are only going up to 70% LTC, and a lot of them are going up below that. And so even though you're the bottom tranche of the loan, you still have 30% equity subordinated below you, meaning 30% losses can happen before you ever lose a dime. And then the rate is anywhere from 10.5 to 12%. And by the way, that's an unlevered return, right? So a lot of times when you think about total return, and when you're seeing things that are, 15% or 18% or whatever you're being shown, remember that's a levered return. I'm giving you an unlevered return. It's 10.5 to 12% unlevered, right? And you have 30% subordination. I like that a lot. So we're taking a hard look at this, but this isn't, unlike Giordano's or Kingwood Medical, this isn't a deal we're pursuing. This is a business line we're pursuing, because once we start doing this, we're actually in the business, period. And the dislocation in this case is what's allowing us, because we have capital and expertise, to step into this position where probably in a normalized market, it's quite hard, because these are long-term relationships that exist between the agencies and capital providers with expertise. Dave, you want to go on to the next one?
Sure. And yeah, we're very excited about that program and strategy. And there's as you mentioned, a big velvet rope up to get across, and it's a pretty exclusive club, and we're trying to become a member. So more to come on those activities. But unlike Dave's, what he talked about was a specific strategy. I'll talk about a specific deal that we've been spending some time on, both pre-COVID, and then it's come back around again for discussion. But for confidentiality reasons, I can't really disclose the specifics on the market or partnership names, but I'll give you a little flavor on the asset quality itself, and I think it'll provide enough of a visual to understand. But this is a Class A, newer constructed. It's built in 2015, so relatively new constructed, multi-asset. It's in an urban infill location, strong demos, some barriers to entry, all the things that we look for in quality real estate. And the thing that, again, not too dissimilar from what you mentioned about what we like about this opportunity is, again, protection. And there's really three things that we're looking at that we're excited about. The protected structure, number one, which I'll go through just very quickly. Number two, optionality, which is what we look for in really every deal. And then three, the basis. So this particular investment opportunity is a convertible pref equity structure. And for those of you who don't know what that means, that we will receive priority distributions in front of the common equity. So just like Dave was talking about on the Freddie K series pieces, there is a fair amount of common equity that sits in front of us in a first loss position. So they are subordinated to our return on our investment. The convertible portion of it is that we have the opportunity to buy out the common equity ownership if the value fell to an attractive level. So that's really the convertible portion of it, which is in fact the optionality. So I'll kind of run you through the two different scenarios that we could achieve. Worst case, based on the structure that we're contemplating, we would achieve about a 25% annualized return over about a year and a half from a very well protected position. Best case is we can convert that position to common equity, again, if the value fell to a level that we felt was attractive, through a buyout of the majority equity partner. So then, in that scenario, we would actually realize the full potential of owning as common equity. But in both cases, our basis would be below the cost to actually build this asset new today, and roughly 30 to 40% below the pre-COVID level pricing. So this feels pretty well protected even in this environment. And one thing that I'll mention here for you owners and developers out there, this is precisely the type of structure that we're looking for in the market. We've built our company to be very flexible in terms of where we place our capital. That's one of our strong suits. And what we're looking for are really recapitalizations or equity infusions on development deals and existing assets. in different forms and fashions. We talked about that with the Kingwood and the Giordano's examples, but in this one in particular, those are where we think we'll add value in this environment. We can move quickly, we can structure creatively, and we're positioning ourselves to be a liquidity provider for troubled partnerships. This is right back to what you said before, Dave, right back to where we were before in 08, 09. We stand ready to be there again today.
Yeah, when I'm listening to you, it reminds me of the call we had yesterday with a really top-notch developer in Atlanta. And, normally they're trying to explain a submarket or explain why this particular deal or hard corner makes sense, et cetera. And, we were very respectful, but the reality is we own, hundreds of millions of dollars of real estate, not only in Atlanta, but in that submarket. We know the market really, really well. We own the market. We get it, right? And so, but that allows us to be much faster in terms of quick turnaround and yes, no, or maybe it comes really fast. And I think people appreciate that. All right, we made up a ton of time and that was great. We're moving on to Origin Take 5. I can see we have 15 questions in, but there are also, I think, another dozen that came in before. So Dave, you know the rules. It's by the letter of the law, it's 5 seconds, but it's more like 15. So let's start. You can ask me the first one.
I think you averaged about 42 seconds the last time around. So we'll see if we can do better.
All right.
All right, so we'll start with a couple of the questions that we received beforehand, that we can jump into the Take 5 questions that we got here in the Q&A. But this is a good one because we don't necessarily partake a lot in the workforce housing segment, but we've had a lot of questions that have come in from our investors and others in the marketplace. But the question here specifically is, in workforce housing rental market, how much of a sales price adjustment do you see in the southeastern U.S. and Texas, and when?
Yeah, I don't know enough to speak intelligently about that. I would be reticent. I might kick it back to you. I will say that because we're just not in that subset. We're in Class A and A minus, and this is obviously not that segment. But I will say that in the Southeast, I know that some of the unemployment, Florida in particular, is not working well. And when you don't get the state to, to give you your unemployment, which you have earned and deserve, you also aren't eligible for the federal subsidy, which is the $500 a week in addition, because it has to be processed and run through the state. And so I know in Florida, if you're in this segment, workforce housing, unfortunately doesn't have a lot of savings. And so if you're also in a situation where you're not getting a lot of needed help, it could be difficult on collections in the short run. That doesn't affect the long-term value of an asset. The long-term value of an asset is the net present value of all future cash flows, right? So I'm just saying in the short run, there could be some risk on collections. Dave, do you want to add to that?
I mean, I think you summed it up well in the minute and 20 seconds you took to answer that.
Oh boy. Okay, I gotta average down. And the funny part is, I talked for a minute and 20 seconds about something I don't even do, which is kind of interesting. All right, back to you. Over the next 3 to 5 years, how do you expect workforce housing to fare versus A and B multi?
Okay, so here's my chance to answer the workforce question, a little bit different in terms of focused on rent, as opposed to, I guess, operations versus values. But I'll just say that relative to A and B, I'm just going to echo what you said, is that there's going to be more challenges for that segment, that demographic to pay. And I think the silver lining is going to be is how well does this government stimulus that we started the call with, how well does it work? How long does it last? But these are short-term disruptions, and that segment of housing will exist in a perpetuity. So I think A and B will likely outperform the next 3 to 5, but I don't think that you're going to see, overall distress in gutting of the workforce housing product.
Okay.
Segment. All right, so question back to you, just more of a broad question on leverage in particular. When to use leverage in real estate and when to not? How much leverage to use and when is it okay to use it?
Well, remember, leverage is a magnifying glass, no more, no less. So if a deal is going to work really well and you use a lot of leverage, it'll work even better, right, on the return to equity. And conversely, if you use 90% leverage and there's a 10% correction, you have no equity in the deal and the bank's looking, or the lender is looking to take it. So it just magnifies both. So I can tell you, we don't use a tremendous amount of leverage, but I don't judge others really. I mean, it's really it's a judgment. I would say um, you shouldn't, typically you shouldn't use a lot of leverage if you're pairing that with cash flows that are uncertain, right? Because if you think about the various forms of risk in real estate. There's asset risk, right? So if I told you I have a multifamily deal and a hotel deal and you don't know any more information, the hotel deal is inherently riskier just because it's a riskier asset. That's an asset that doesn't, it's relying on cash flows that aren't certain, number one. Their leases are nightly and they're discretionary. You don't have to travel, you don't have to take a work trip, et cetera. You do need a place to live, right? So we can agree at the asset level, there's more risk in certain assets than others. There's also idiosyncratic risk. So that's project level risk. And so that was, the example I would make here is if you have a fully leased cash flowing multifamily building, or you have a multifamily development that's 2.5 years away from cash flow, everybody knows the development's riskier. There's a whole lot of things that can go wrong before it gets to the least cash flowing phase, right? And so that's idiosyncratic or project level risk. And then the third level of risk is debt to equity risk. So the more debt you use, the riskier it gets. I would just use that frame, right? So if you're an investor trying to figure out how much to use, create that frame. There's asset level risk, there's idiosyncratic risk, and there's debt to equity risk. And if you have a lot of risk in buckets 1 and 2, you probably don't need it in bucket 3. Right? And that's really been a good compass, I think. All right, for you, are you concerned about the overall debt levels in the country, Dave? From the Fed all the way to the individual? Well, I'll throw the states in too. It's not part of the question. I'm in Chicago, so I'll throw in some city debt. Go ahead.
I mean, this is a deep question. I mean, it sounds, straightforward, but there's a lot of levels to unpack. I'm not going to try and go there. I mean, I'll give you the short answer. Am I concerned by all the levels of debt that you just mentioned? Yes, I am. But when I think about in terms of, you can look at this in a few different ways. I'm not sure how people view where we're at in the long-term debt cycle, or if you even subscribe to that theory, but we have some overhang, as we discussed, from 08, 09 that we're still working through. We entered this with a $4 trillion balance sheet in the Fed, going to 10, as we talked about, potentially more. I'm concerned about that. But I guess what gives me some comfort at the end of the day is I still believe that and we're seeing market level participation in buying our debt. And the treasury yield is still at 64, 67 basis points. I mean, it's still the best thing out there for consumption and buyers of debt. And I do believe in our ability through ingenuity, entrepreneurial spirit, flexible rules for capital formation. I bet on the U.S. long term. I think most of the world will as well, but we do have to get our house in order. And there's going to have to be some pain that's taken at all those levels you just mentioned down the road. I just don't know when that's going to be.
I'm gonna just add a tiny bit to that because it's such a good question. How it affects real estate, though, because this is a real estate webinar. There are two things that I see as scenarios that come out of this massive level of debt that we're assuming now, right? One is we have a deflationary period. That's not necessarily just from the debt. It's actually from 16 to 20% unemployment, which is what we effectively have right now, and underemployment on top of that. And that doesn't even take consideration some of the gig economy that's not even measured. So there's an awful lot of unemployment, which means there can't be much wage pressure. and not much consumption. And so that's all very deflationary. So I think that even though there's so much stimulus, there probably will be a low level of deflation for the next 12 months. And when I say 12 months, I'm assuming that there's normalization and there's not a second wave and all these things that could extend it further. That's kind of my good scenario. Now, what can happen from there is less certain. If you have the Japan model, they've been in 30 years of government stimulus, zero interest rates, adding to their balance sheet, buying equities, all the things that we mentioned, some of which the Fed isn't even doing yet, but they have done there. And what's happened is surprising. They haven't seen inflation. They've actually seen slow growth for 30 years. And that could be what happens here. In fact, that is what happened. If you look back to 08 to 10, you had you had this government intervention and Fed balance sheet building, and then you had 10 years of slow growth. And so it could be that happens again, and it takes longer. I will say for real estate, low interest rates, low growth is actually a very good environment for real estate. I mean, think about how well real estate did over the last 10 years. So that's not so bad. The other scenario is you have deflation, which when it works its way through, and you'll see that when the unemployment rate goes from 18 to 8 to 6, and now all of a sudden you start seeing wage pressure, right? Because there's actually a low enough unemployment rate that you have to stretch for labor. And you also see confidence of entrepreneurs to start opening businesses, taking out loans to do that. And that creates what we call an expansion of the M2 and M3 money supply. And that's the multiplier money that Dave was talking about. If that happens with the record amount of capital that's now in the system, you could see inflation. And I'm not saying it's going to be crazy inflation and, it's the 80s all over again. And for those who were around in the 80s, I wasn't that old, so I'll just not make myself 100 on this show. But I will say you could see 3%, 4% inflation, which is, way higher than it's been. It's been more like 2 for the last 10 years. So in that world, ironically, real estate does pretty well again, right? So I feel good about real estate in the medium to long term, because those are the two scenarios I see. And in both of them, it's an asset class you want to own. But I think that there's a potential for repricing in the next 6 to 24 months, and you just have to be protected and aware of that. All right, we're moving on. That was the longest 5-second answer ever, and we both did it. I'm going to move on to the questions.
We have 7 minutes to get through
Q&A. We're going to move on to the live questions. So we actually covered collections. So let's take Pierre's question about coronavirus and its impact on development of office assets. Can you handle that one, Dave?
Yeah, it's a good question, and one topic that we talk about quite a bit internally, because we do have office assets in our portfolio, and from a prep perspective, we can provide capital there. New developments is going to be anything that's not in planning or in process right now. I think there's going to be a huge drop off in new development of office. In a lot of our markets, in the 11 markets that we invest, there actually were pretty healthy supply pipelines that were already underway, not speculative developments to the level that we were seeing really in 08, 09, especially in markets like Atlanta, where they're delivering 2 million square feet of spec into this environment. It's been a little bit more controlled, but I do see that the utilization of office is going to be tested. And there's a lot of questions and thoughts coming out of this on, are we actually going to use a lot less space because this telecommuting and working from home is working relatively well? Do we need more space? If we were at the lowest level of utilization highest level of utilization per square foot per employee going into this, does that go back to 600 square feet per employee when we were at 150 before? Don't know. So I don't have a great answer for you, in that it's gonna taper off dramatically from where we were before.
Yeah, I've seen both sides of that argument, right? The one side is people are getting used to virtual work and there'll be some unit of demand less for office going forward. I've seen the counterpoint, which is we're going to have an expansion of space per employee because we need social distancing. And so offices will expand in that way. My opinion is the first variable will be more powerful than the second. So I think you'll see a net lower demand for office. I don't think it'll be dramatic, but it'll be lower. And it doesn't take a lot to change valuations of assets. I'm going to move on. Really good question from, I think it was anonymous, but anonymous question. What were the return Origin had on 2007 acquisitions? Which is a great question. We actually didn't acquire anything in 2007, so I'm not trying to dodge the question, but we were setting up the company and hiring people and getting infrastructure in place. So we didn't do that. I will say that in '08, we did make an acquisition of roughly 100 multifamily units, which came in the form of homes in Southwest Florida that we bought from failing credit unions at the time. And so we were very, very early to buying debt. We didn't buy the homes, we bought the notes, and we, through both mainly deed and liens, but some foreclosures, took ownership of the units and then converted them into a horizontal multifamily rental strategy. And we wound up doing very well on that investment, but we were early because this was pre-Lehman. So we bought those in the spring and summer of '08, and then Lehman happened, and we would have been able to buy them even cheaper had we waited. So I'm not trying to dodge the question, but that really was the only acquisition we had before it truly repriced. You want to take Naveen's question?
Sure. How are you looking at the public markets in terms of potential angles to buy distressed debt or equity behind some of these troubled REITs? Great question. It's actually a strategy we've already been looking at and pursuing. We pulled up a multifamily REIT that we know their holdings pretty well. They overlap in a lot of our markets, and we looked at their underlying debt. And a lot of the debt that they issued was really at the project level, which were pretty well disciplined, in terms of its loan to cost or loan to value, knowing who the lenders were. They were 60, 70-ish%, 65% plus or minus leverage, that we don't see a lot of those loans being impaired. Now, we looked at the public equity markets as well, and we do, and Dave, I know Dave's going to be jumping on our public REIT webinar tomorrow, but we can talk about our strategy there, but we have been buying public preferreds in our income block, and we're big fans. There's been a lot of repricing in that market. And there's also unsecured debt in a lot of these public REITs as well. We've looked at it. We don't think that's going to be impaired. Short answer is we're investigating it. We haven't seen any REITs in particular that we found that we think are going to be immediately impaired, but we're continuing to monitor it.
Yeah, and we see huge opportunities in the preferred equity space of public markets, Naveen, and we're actively pursuing those and have a portfolio manager who does that. So I believe Thursday we're covering exactly your question, and so I hope you have an opportunity to tune in. I'm going to move on, and I'm going to combine two questions in my sprint to the finish. So one question is, with not much of a move in private sales pricing, is now the time to invest, or could you see a delayed private market repricing in the coming months? Second question is the Origin management team advising new investors to invest? I'm assuming you're asking in private or hold off. And the reason they're interrelated is, to answer the first question, yes, it is going to take time for the private market to reprice. It always does. Sales, even in a normalized market, take 90 days of institutional quality assets. So anything that was in the market, all the stuff that Dave was talking about earlier, the 178 deals, those deals were in process in February, right? So the new stuff is just starting to be listed now that debt markets have normalized. And you're not going to see a lot of the repricing hit the private market really until, if it's May now, you're talking about June, July, August. That's why webinars like these are really relevant. And we'll keep doing them because it isn't priced in. Second question is it time to invest now? And the way we're structured on the private side, all of our funds are open-ended, number one, meaning you can invest at any time, and they're perpetual. And so these are long-term investments, but we reprice the share price every quarter. And so, if we believe that assets are down, and we do, not a lot, but some, we will be lowering that share price to reflect that in the same way that we would write up that share price if we believed assets were up. So there's not really any reason to wait. You're buying into a share price that in this case would be moving slightly lower. We'll be doing that in the next month so that new investors can get in at a realistic and market price. And the other cool part about a open-ended fund is when you commit to the fund, we're actually not taking your money. What we're saying is the next asset that we have a need for equity, you're in line. So if we have 100 people in line, you become the 101st. And if all of those people equity is taken in full, then you will have all your equity taken if we have a need, and then you'll vest into every asset into the fund. So the way we have it structured, it doesn't really matter that I believe if we're going to reprice lower, it'll happen in the next 6 months. You wouldn't need to wait. If you're asking a question about, hey, I want to go do it on my own, should I wait? That's a hard question to answer because I don't know the opportunity set in front of you, right? But I would say broadly, if you're in multifamily, if you have an asset that you think that you can underwrite to a 10 to 15% discount to pre-COVID valuations, total asset, I would say that you're in the right zip code. All right, Dave, I covered 2, so I should have had at least 10 seconds, right, by our rules?
Well, I think we're out of time. I will answer this one question. It was about my haircut. Somebody suggested why I have such a perfect haircut during COVID. The short answer is my wife gave me a haircut about 3 weeks ago. She took the number 4 guard out and did her own version of the fade. So if it's not perfectly blended, it's her to blame. But that's the answer to that.
Okay.
I think we're about wrapped here, Dave. We're at a little over 2 o'clock Central.
Yep. I want to be respectful of people's time as well. So thank everyone for their time. We did have about 12 questions we didn't get to. Maybe we can follow up. If we have your information, maybe we can follow up directly and answer them because they're all great questions. We appreciate your time. Please send in feedback if there are portions of the hour spent that you really enjoyed or you thought were a bit too long, et cetera. All that's great feedback. We'd love to hear it. And stay healthy. We'll all get through this and we'll emerge on the other side. Be safe.